Hello, Warriors. Hope everyone had a good weekend. Hi, Alexander. Who's Rick? Warren. Thanks. Doing a shade better. Jeff Hansen, how are you? Hugo. Hi, Scott. How are you, bro? Let's take a look around. Richard Adams, how are you? Oh, Ryan. Okay. So we're getting a little risk off here so far today. And Euro's a little bit weaker. Here's the way I see Euro. And it looks like it's going to challenge it. As long as we hold 1750, we're okay. All right, that's a pivot now. So if we take it out, I'm looking for one more new low before we get a better rally.
Dale, I can't see your screen. Yeah.
How about
Good morning.
now? Morning. So
there you go. You got it.
Okay, so yeah, here's that pivot. This was, a breakdown, a false breakdown. And to me, it's an important level for it to hold. Otherwise, perhaps we're going to get one more rally in Dixie. Up here, we did have a confirmed high in the Dixie. One more high and then a better correction. Even though the dollar's stronger, the yen can't mount much of a rally. And Canada's pretty strong. Aussie looks like it's getting ready to make a new low for this formation. I think we have, I don't know if it's the Aussie or the Kiwi. We have central bank meeting this week.
Kiwi, it's the RBNZ. Yep.
Okay.
And they're expected to hike first one.
Okay, it's got a better looking chart than Aussie, so we'll see what happens there. EG, a little bounce. It looked like, we're back over the throwover. But if the euro's going to make one more low, I don't think the pound will. I think the pound will hold this low. Okay, even if the euro makes a new low, say to 1680 or something like that. Gold giving some of it back. Much stronger rebound in gold than silver. Still looks that way. Maybe the gold around 1740. I'd be watching that because that was kind of the target from this formation, even though it overshot. And oil better dig in its heels here above this blue line of 550, or we could have a breakdown. CAD is a pair. Yes, that's what I mean, John. Hi, Sinatra. How are you? So in here, we always talk about the pairs. That's what we're trading. You might be trading futures. So that's any questions on any of the looks. We pointed out that the VIX was down to single digits. It's going to gap higher this morning. There it is. So the S&P's made new highs without new lows here in the VIX. I would not be short volatility here. And finally, yields. We had this big pullback in yields. Okay, we have this pullback on the consumer confidence, which is a backwards or looking indicator. It's not a forward-looking indicator. So I think as long as we hold 120, we're going higher. The only thing that gives me pause on rates making a big move higher would be, I still think we're going to have some risk off coming, not just today. Even if we make a new high in the S&Ps or NASDAQ, I think risk off is coming, and it's hard to want to think yields are going to go up during that time frame. So that's what I see. Good morning to you, Stell and Blake. How are you guys doing? Kind of a quiet August Monday, halfway through the month. The adults will be back from the Hamptons in another 2-3 weeks.
Yeah, it's a quiet day. I think we're all waiting for the next couple of weeks to kind of grind,
Pass.
and,
Yeah.
until we get to Jackson Hole. And
Yeah.
unfortunately, we're going from one event to the next, and there's not enough surprise, let's say, for markets to really move. But we're optimistic. We think at some point something's going to happen. The RBNZ tomorrow night is expected to hike. First
Yeah.
central bank to do so.
No.
No, what?
No, you can't say that. What is Banxico like chopped liver? I mean, come on, man. Good morning, guys.
You're right.
Hey,
I think the
Blake.
Bank of Nigeria also hiked.
And Zimbabwe.
Hey, no, Banxico did, but they did give us a
they did.
surprise rate. I know a lot of people don't think of Banxico as one of they're definitely not a G8, G10 central bank, but a lot of us here in the currency market, myself included, trade the peso, and they did hike rates. And you're right, though, Stelios. The RBNZ is expected to raise rates this week.
Yeah, and I think the next one, realistically, is Norges Bank. They've said already that before year end they're going to hike. The question is when. So,
And don't forget Afghanistan. The Taliban have tightened by taking control of the capital.
The thing about this, the whole situation in Afghanistan. I mean, that if you think about it from like a macro, I guess, perspective, because obviously, a lot of people start asking, well, what's happening in Afghanistan? Is that going to affect the markets? My opinion is no, not at this point, but it's going to create a lot of political, it's going to be more of a political issue moving forward for the Biden administration, which is going to make, in turn, anything else that they're trying to pass from an economic standpoint, probably a little bit more challenging in the remainder of his, probably for the next year or two, or moving forward. I would assume that would be my assumption.
He's got a black eye.
He does, yeah, absolutely, he does. And so, I think that's going to weigh. Yeah, that's going to weigh on whatever people are thinking, is going to pass politically moving forward. So anyway,
and Maldonado is calling him Jimmy Biden, which is a take on Jimmy Carter.
Yeah,
on his 1970s analogy.
Yeah, that I could see that totally. So it's going to be interesting to watch. But I'm glad you brought that up, because about Afghanistan, because people will ask, if this is going to affect the markets at all. So,
anyway. The last big nation I remember leaving with their tail between their legs was Russia.
Russia, yeah.
And we know what happened to Russia after that. It wasn't really such a good sign. A few years ago, the whole Soviet Union fell apart after that.
Well, I don't think it was. I don't think the two events were tied, but I think, the Soviet Union was due to use under Gorbachev's leadership. They were going to get split up at some point eventually. But I agree with Blake. I think the Afghanistan situation is not something that should worry the markets now. And look at equity markets. Okay, we're down a little bit, but really nothing. And the question is, what implications does this have? Afghanistan is not an oil producing country, is not something, they export rugs and fruit and opium, I think. So it is going to be something.
I'm only worried about the opium supply.
Opium.
The market. Opium. Yeah.
It's going to be an issue, but at the moment I don't think it's going to affect markets really in any serious way, let's say.
Yeah. Okay. And we're probably not going to be taking a vacation there anytime soon either.
Yeah, it's not in my plans to go.
Are the fires under control in Greece now?
Yes. The problem is that they found loads of evidence that they were started on purpose, which is very worrying.
God, I hate arsonists.
Yeah. Anyway, we're under control now. Okay, opium is life, says Nitish. Yeah. What else? We had it's worth mentioning, markets are a little bit lower overnight. I think the main cause is probably not Afghanistan that much. It's China. We had some pretty bad misses in industrial production, retail sales. So it looks like the Chinese economy may be starting to stutter a little bit. But as I said before, I think all this is relatively insignificant ahead of the Fed in a couple of weeks' time.
And if you're looking at their equity markets, like I was just pulling up for everybody here, like here's Shanghai. We had a little bit of a scare a couple of weeks back where we plunged through some support, and the market's not really moving there, and the Hang Seng, kind of saying
that looks worse.
Yeah, I mean, this is. I mean, all these Asian markets all look the same. You had this, sell off a few weeks ago, and then kind of a recovery. But we're just, consolidating.
Like a breakaway gap.
It's summer, man. It's summer.
Yeah.
What are we're I mean, are we going to get a whole lot? I mean, you look at. I'm just going to give you guys a little heads up. You look at our team. We're missing. Amanda's out. She's got her feet in the sun somewhere. Ryan's out for the next 10 days. He's out, camping with his family, out in the wilderness. I think he's taking his kids out, teaching them how to poop in the forest. What you have to teach every boy. By the way, just so you guys know.
Yeah, and you teach them not to use poison ivy toilet paper.
No, everybody's got to keep a poop bag, with them, with some toilet paper.
Like a doggy bag.
You got to keep it in, waterproof. Right. We do that all this stuff. Anyway,
remind me never to go on holidays with you, Blake.
No, I'm telling you, I'll teach you how to dig a hole. Get rid of it.
Thank you.
All right. All right. I gotta tell you guys,
Steve is out as well, right?
Yeah, Steve is out. Steve's on holiday for the next. He's in Rhodes. No,
Corfu.
He's been on holiday all month.
Yeah, I mean, that's a Greek for you. I mean, no offense, but no, we got Steve out. That's just the market. I mean, most of Europe is away right now. I mean, our chat rooms are fairly quiet because a lot of Europeans are out. I mean, it's just the way it is. But anyway, this is summer markets, and we're going to continue to see the markets probably tighten up. But I want to point out just a couple of things really quick, because I know I talked about this on the week ahead video, just the consolidation that we've seen in the markets. Like here's the Kiwi dollar ahead of the RBNZ. And, we do have the rate decision, as Stelios is pointing out, but this isn't tonight. This is actually Wednesday morning, which is Tuesday night for most of us, right? And so we still have another, 36 hours of consolidation here. And, you look at the Kiwi, it's not going anywhere. But you look at the Aussie, and this continues to show you how weak the Aussie dollar is. As a currency. I mean, hold on.
You've been pounding the table on that for months.
Yeah, I actually just closed out a pattern in play in the Aussie, not on the Aussie, it's not a pattern in play. I do have a pattern in play for the Aussie short, and actually Greg put one in earlier today. You can see it. This is, a pattern in play that was put in on the 11th, so last week. But in the chat room, here, I'll just show you guys. So those of you that are in the chat room or not in the chat room, you can see in the trades room, I closed a Aussie yen short for 95 pips from 81.15 average. Some people got better prices than me, but I closed half of it last night and then the other half today. So last night, I think I closed the other half at for 54 pips. And then I took the remainder off this morning. Yeah. And the reason why I did that, just so you guys can see, well, first of all, it's summertime, right? But we were at horizontal support overnight. We were like right around these levels, and I'm like, okay, we're in Asia. Yeah, I'm not sure if they're going to run this through the rest of European trade, and we were coming through like some of this horizontal support. And it was 127% extension of this move. And so I didn't want to like overstay my welcome on a lot of it. So I took a lot of it off the table here. Then I took the remainder off this morning because look, this is a big, 161% extension down in the Aussie yen. And I know we're near some key support. So, but you'd mentioned it right, Dale, the Aussie is very heavy and it trades heavy and it continues to trade heavy. I mean, you can see, I'm looking at the Aussie dollar still pointing towards, 71, this flag pattern here, still points to 71, 71 and change. So, I look at the Aussie and I think it's still got a ways to go. And that's really the same for a lot of these dollar pairs. I think a lot of people came in to this week very very
Bearish the dollar.
Very bearish the dollar. They came in, very bearish the dollar. I saw chart after chart after chart, like, everybody just saying, oh, big rejection
Have an arrow down.
Yeah, big ugly candles. So, you got people trying to fight that trend first thing in the week, and they're getting, kind of run over at this moment.
Probably some stops over Friday's high. Did Friday's high take out the previous high at near the same level?
For the dollar index? No, it
Yeah.
didn't. And
Okay, so
there
could be a stop hunt above that then.
Oh, well,
Probably.
everybody, the first thing that comes to everybody's the first thing that comes to everybody's mind when they see resistance hold, first thing is what? It's a double top. It's a double top. It's a double.
Especially being the dollar and everyone's proclivity to want to be bearish.
Yeah, right, exactly. And I'll tell you, have you guys ever seen? And let me do this. I'm going to pull up give me a stock that I'd never ever look. Crude oil is hitting lows, by the way, and which is putting the dollar Canadian at highs and the US dollar Norwegian krona at highs. Give me, well, you know what? I'll just do this. I never look at this dollar index and whatever it is called. Okay. Stelios, you still here?
Nope.
Okay, good. So whenever you see an asset rally, right, and it hits a high, and this is what I'm talking about with the dollar index. Everybody at this point in time automatically thinks, oh, that's a double top. It's not going any higher. But have you guys ever seen like a bullish wedge develop?
Yeah.
Right.
Yeah.
That's what can happen when you have a bullish trend develop into something that, at first you go, oh, look, it's a double top. But, if the underlying asset is bullish, like I look at the dollar, why would I say the dollar is bullish? I mean, in essence, why? I mean, I look at the dollar and I see it, and let me just delete this really quick. I look at the dollar index and I go, okay, well, the dollar is setting up, we have obviously some key resistance, but why is the underlying asset bullish? Well, my opinion is that the Fed is looking to taper asset purchases, and they are going to be moving a lot quicker than probably most central banks at this point. Right.
And the big double bottom is more significant than the recent small double top.
Yeah, or you could really say again, I can go back to the end of 2020 when the dollar was the quote unquote best short of 2021, and we made a higher low. So now the risk in this case is that we are going to break higher. And like I said, I'm still targeting 94 and change. We could even go higher than that. It depends on, if we have any type of risk aversion plague the market and how aggressive is it. So anyway, just some food for thought for those of you that think, oh, the dollar is done here, it's not going higher. I would respectfully disagree with that. And that's my view. And it doesn't mean that I'm right and, everybody else is wrong. I'm just saying that overall, you have to respect the fact that the dollar has been holding up very well in this environment. And that's probably due to everybody thinking that the Fed is going to be raising rates in the raising rates. I'm sorry, reducing liquidity over the next few months, quicker rather than later, due to inflationary pressures and a very robust economy. I mean, I know a lot of people might think, oh, but the economy is not really, it's really not that great. No, it is actually really good, right?
Blake, we have to also, sorry to interrupt, we have to also listen.
Please.
We have to listen to what the Fed, members are telling us. And one thing which was a little bit surprising to me, at least, Minneapolis Fed President Neil Kashkari, this guy has been the biggest dove of doves.
I saw him in The Mummy.
Yeah, and he said basically that a few more strong jobs reports over the coming months would be enough for the Fed to start tapering. So even he's giving us his kind of green light for tapering, provided that data continues to be good. So, we have to look at what they're telling us, and the majority now are telling us that this is coming. The market still kind of believes them, but maybe is not convinced about the pace of tapering. But I'm starting to think that this is that the surprise might be on the to the high side, on the hawkish side, like you say, and that's the danger.
Do you guys see him in The Mummy too?
I didn't see. I just read about what he said. I didn't see him. Oh, that's good.
Yeah, I mean, he's been in the. Yeah, look, here he is here, and then here he's in The Mummy. I
He
always
does look like him. Yes.
I remember the very first time I saw him on CNBC, which was when he first joined. And he wasn't even at the Minneapolis Fed at that point, or was he? Yeah.
I thought, anyway, by the way, before I thought you were saying In the Money, the show on.
Oh no, I meant In the Mummy. But
yeah, and I was like,
when he left Goldman and he joined the Fed, and he first jumped on CNBC. I must have been like 8, 9, 10 years ago. I was like, dude, that guy's in The Mummy. And obviously it's a thing. It's a thing anyway. But yeah, this is the thing about the Fed governors. You see them all, and I mentioned this during the week ahead video, guys. They're all falling in line, and they're all the little soldiers are falling in line. And so all we need to hear now is from the big kahuna himself. Powell turns hawkish, and game on, baby, game on.
Yeah,
right?
Kaplan was very aggressive with the call. He said, well, it's like a doctor giving you medicine and it's no longer helping, and all you're getting are side effects from it. When he's talking about the bond buying.
Yeah. So, and isn't this funny, Dale, that we actually had the same conversation probably 2 years ago?
Yeah, it's like, at times this business feels like Groundhog Day.
It does.
Doesn't it?
It does. And I guess it feels even more like that for us because we, before COVID happened, we were at that, I felt the exact same way as I do right now. And I was like, man, we've had this quote unquote emergency, monetary policy for 7 years now, and it's like, oh my God, it's never going to end. It's like, please get me off of this roller coaster. And then COVID hit. Obviously the market finally corrected, but not due to the Fed reducing liquidity. They just slapped on another 3 times the amount. So hey, here's the thing. We could go round and round and round about this subject, but guess what? We have a special guest here today for the next few minutes because, Dale, I know you have an interview. Paul Franco is here with us. Paul, good morning.
Hey, Paulie.
Hey, how you doing?
Hey, welcome, bro.
What's happening, man? What, Paulie?
Yeah, I'm here. Can you hear me?
What's yeah. So for those of you that don't know Paul Franco, here's Paulie, and Paulie, he does our European crossover webinar that's specifically or exclusively, for the Forex Analytics subscribers. But Paulie is like scalper extraordinaire in the NASDAQ, he's like, well, Paulie, tell us a little bit about what you're doing. And I know you're in the chat rooms. You're super active in our chat rooms, but what markets are you slaying nowadays? What's got your attention?
Well, I mean, I primarily trade the NASDAQ now, but I do trade a little bit of S&Ps. I kind of keep those in tandem. And then also a little bit with the crude oil. We caught, actually the other day, I was targeting, when we broke down, we were targeting a move to, I think it was on the September contract. I think it was 66.24. Anyway, the low was 66.15, so we missed the low by 9 cents. And I got long, but I ended up scalping out of it. I didn't get back in it, but we were looking last week. I was calling for looked like we had a pretty good resistance of 69.40, which is exactly where the market ran out of gas. It was 66.40. I don't know, because we rolled over to October. I'd have to go back to the chart, but I never did get back in it. But we just sat there for about a day and a half, almost 2 days. And boy, did we break. We eventually broke down, and now we're down at 66.24. That's the October crude, because I've already rolled into it. Yeah, it was 69.40. Then it was 69.40 on the September. And we sat there, actually had a guy short. It only felt like about 25 cents. It came right back, and it vacillated. Eventually, it did break below 69, but it popped right back into that 69.30ish to 40ish area. And then finally, we rolled over. And boy, did we roll over, and we saw a pretty good sell-off. We actually have support on the buys chart this morning. Actually, we're below it. We had support at 66.58 on the buys chart. So we're just a little bit below it, but there's some good support down here. But it's probably just because we're starting out Monday and probably caught some people short or long over the weekend. So maybe they're pressing them into the cash open.
One of the, I want to mention then, thanks, Paulie, for your update regarding crude. And, this is kind of like the opposite of the dollar index. Everybody's looking at crude and they're like, double bottom. That's a double bottom, and then you start looking at it and you're like, is it, is that a double bottom, or are we just developing a bearish wedge where, eventually, it's going to take all these longs to the cleaners? I did have a conversation with Bill Baruch from Blue Line Futures last week, and he's very much a crude bull, and he's looking to buy crude, on a dip down towards the 200-day moving average, which at this point in time comes in above 60. It was below 60 last week, but now we're like 60-40 or so, and that's where the 200-day moving average. But it does look like crude could correct a little bit here, right?
Yeah, it looks. One of the things, if you go back to that the amount of time that we stood there, and it wasn't even that long, but we had that nice bounce off of that 66.24 area, and we kept rallying. We took a dip back, and then we ran up to 69.40. And while we were sitting there, I said, it was like the following day, and I said, well, you know what? If we break above here, it's a quick shock to 70.27. The point is, they had the chance to, longs really had the chance to skewer some bears there, and they couldn't do it. And it sat there for a couple of days and even made one more run on, I guess it was on the 13th, back above $69. And that's what I'm saying, is it just couldn't do it anymore. This is reminiscent on a very short time basis, but it's reminiscent of exactly what happened with gold. If you think about it, when gold was up there at 18 and it couldn't bounce above any higher, and it kept breaking back to 1802, maybe just a little bit sub 18, and it come right back. And if you were following on the whatchamacall on the our European crossover webinar, I was beating the hell out of this thing. I didn't trade it. I'm saying I was beating the hell out of it from a technical standpoint, saying, look, this thing just can't go any higher. It's going to break lower. Now, I never thought it would break like that, but I thought it could go down to 1740. But then, 2 Sundays before, not this Sunday, but the Sunday before, all hell broke loose, because the same thing of what you're seeing. If you're looking at crude on a very short-term basis, like a 2-hour basis, it's the same thing that happened. The wheels fell off the caboose on this crude from $69. Now here we are, almost down to 66, because all those longs just got thrashed out. You're seeing the same thing with you. Yeah, you look at your chart there with gold. You see those 2 blue lines, and I was saying how it kept rotating above it, and we had the VWAP off of the lows back in March. Was coming in at 1818. I go, hey, there's a resistance. And I said, if we get above 1824, we can jump up to 1873. We did, but then it just floundered for a day, and we came back. So we broke down into 18. We made one more rally again, and I'm saying, look, this is looking terrible. And look where your trend line intersects. If you look up just to the left, You know, to the left, a little bit higher. No, the downtrend line, right there. Okay, right now move a little. Okay, do you see that bearish engulfing bar? You got it right there. You got it right at the top. There you go. Just to the right. Move to the right a little bit more. Move to the right. Move that right there. Okay. On that day, that's when all of a sudden they blew the stops on the upside. And within a 2-hour period, not only did they blow the stops, they turned around and gave back, I think it was $20 or something. That already told you right there it was over. They had one more last gasp and then they blew it. Not only did they blow it, they actually gave the entire move and then some back within a 2-hour bar. And then you can see, look at the rest. Look how it drips,
And it just
drips,
bleeds lower.
Yeah, now
Yeah.
I thought my move, I was thinking, I go, okay, we're probably gonna, I remember that day I said, we have support at 1792. Well, actually, it was 1802, but I said, look for 1792. Maybe we'll make it down to 1777. Well, the market closed, but on Sunday, they opened around that 1773, and then they broke, and then all heck broke loose. Well, but in a crude right now, in a 2-hour chart is a microcosm of that, because once again, we were at that $69 and we kept pushing up against it. And then all of a sudden, all hell broke loose right now. Yeah, that 69.40 wasn't even that much of a rally back. So when you see here, if they really wanted to spook them, I mean, they could have goosed them up there and taken us to 70.27. So the fact that we're coming back down here, think of all the disappointed bulls. Even if this was a buy, and we were discussing that this morning on the European crossover webinar. I said, look, when a market dips down there, I've been the kind of person that'll try and catch a knife down there. But one thing you have to remember is when you get that dip and you got those disappointed longs, gold was a perfect example. At that point, no one's going to try and defend on a dip back, like the same way the S&Ps were. They try and defend it, because once you get that hard break, forget it. All bets are going to be off. We're going to slide through that. And gold was just like a unbelievable issue with that. And that's why I'm getting back to the S&Ps, is I'm telling people, be careful with the S&Ps. I'm not bearish. Technically, it's still bullish, but the problem is, and I shared that in the chat room, and I even shared it on Twitter, the volume in the SPYs is the lowest weekly volume that we've had in 5 years, excluding Christmas week of 2019 and Thanksgiving week of 2017. So the key thing what we're saying here is that you're going higher and higher, but the support keeps getting less and less. So if we do break this morning, the support's going to be 44.34.
It's going to be a nasty one, right?
It's good, exactly.
Hey,
you don't want to be
Paulie,
a dip buyer. Because what'll happen is we're going to dip. You might see, and I told people the key level is going to be 44.12. You might get a little bit of a bounce up to 44.20 in the mid 20s. But what's going to happen? Everybody's going to load the boat. And from 44.12, I think we'll drop down to about 43.96. And we might even drop into the 43.80s. I'm not saying today. I'm just saying when we get that first break. And last week was the first week that I've seen, and it was actually the beginning of the month where we didn't see, and if you look at NASDAQ, usually, and I've been there on the wrong side, you get short and like, oh my God, how could I have done that? It's a Monday, and the market just really tears you up. We didn't see that on Monday. And if you remember last Monday, I was in the chat room saying it, and I was in Twitter talking about it. I said, look, this market feels heavy. It feels like it's a car that's running out of gas, and you step on the gas and maybe you'll get one more boom, and that'll be it. Well, we closed at our highs on Friday, on Monday. The next morning, the bottom fell out, and we kept on falling.
Paulie, hey, we have an interview. But
he's so passionate, man.
He is, man. I love it, Paulie. Hey, and here, guys, if you want to get more of Paul Franco, you gotta listen to him on the European crossover. And Paulie, we love having you here because and that's the thing. I mean,
good win too, Paulie.
He's I brought
you don't
Paulie
even have
on.
To breathe when you do analysis.
I brought Paulie on years ago with our team over at MB Trading. And I love having him here because he trades for a living. He's passionate. He's always in the markets, always trading. And anyway, Paul, you're great. Thanks for being on with us this morning.
Okay, y'all have a good one. Bye.
Hey, I'll see you guys. I'll see you in the chat room. And guys, just remember, to take advantage of Forex Analytics, make sure you try it out. It's only $1 for 10 days. And I want to mention this: our webinar sponsor is MB, or is not only Pepperstone Trading, but it's really Forest Park FX. So make sure you guys, if you're in the US, you're in Europe, doesn't matter where you're at, make sure you check out Forest Park FX, because if you're not getting paid, I just actually I had to switch my account over, one of my accounts over to Forest Park. I actually received my first check and cash check in the mail. That's awesome.
Nice.
My rebate check. I'm like, yeah, this is great. So anyway, yeah, you got
Just
you
keep
get cash.
turning yourself, bro.
It's cool, man. It's cool
I
when you get.
know.
I don't
Yeah.
know why I never got cash. Well, I know why I wasn't getting cashback rebates
Yeah.
for many years, because
Yeah,
I was trading through,
they got it.
JP Morgan and
Oh, yeah,
an
they don't do
institutional
that.
account, and I couldn't trade my own personal FX account. So yeah. So anyway,
All right. All right. Well,
Yeah.
Jim Carroll is with us, Vixologist.
all right.
So maybe he'll have some follow-up commentary to what Paulie was saying. Hey, Jim, I can't promote you to a panelist. Did you call in? I'm going to let you talk. There you are. Hi, Jim.
Can you hear me now?
I can, Jim. How are you?
Outstanding. I am great. Thank you.
Did you call in?
I'm in the Zoom.
Okay, but you called the Zoom,
No, I
right?
didn't call, I don't think.
Okay. Can you, let's see if I can get you to share your screen, because I wasn't able to promote you to a panelist. Why don't you try and
Oh,
share the screen?
hang on here. It said,
Oh, now you're coming in as a panelist. Okay. I think Blake did it. All right.
can you hear me now?
Got you.
And
we're
I
good to go,
think I'm a
Jim.
panelist. Yeah,
Yeah, now you are.
Outstanding.
You want to share your screen?
sure.
It's a green box.
Yep.
And
let me get to the
great
right
time
one.
to have you on, I think. As we, and I know that you're joking as far as, what are you going to say? And yeah, you're a regular now. All your friends are asking you if you made the cut. You made the cut. So,
So
what
let
do you
me
think
try
it-
to share my screen and get
here it
some
comes.
stuff up here.
Okay, there's your Twitter
Give me
stream.
a second. Okay.
The VIX on the DSI sentiment was a single digits last week, Jim, 9 on a sentiment service survey that we use.
All right, you see my my slide here?
No, I'm still seeing Twitter, so you'll probably have to do
Hmm.
stop sharing and then new share.
Okay, hold on a second. What's going on? It's weird because I'm seeing it on mine.
Yeah. So
Hmm.
why don't you just hit the stop sharing, and then hit the screen share again and pick the screen that your slides are on.
Which is what I thought I did. That's weird. Now I'm having trouble getting back to the Zoom. Why is that? Where is that going?
Well, let me do this.
Hang
Okay,
on.
there you go. You
Yeah.
got it now.
Now let me try again. Sorry for the
I
technical
don't know about
difficulties.
this regular. You got some ground to make up now. All right, so,
You know,
huh?
I'm
You're-
always screwing something up, Dale.
hey, that's life. It's how you
Okay,
rebound
now.
or adjust to your screw up. So
Why is
something. There you go. Well, I see the red boxes and your slides.
okay?
so-
Perfect.
Okay. So,
Let me try to
tell
turn
us-
that into a slideshow.
okay.
Yeah. So I was last with you in April,
Yeah.
right?
Yeah.
And what we've seen since then in VIX land is really, and I'm not a huge fan of technical analysis on the VIX, because it's not tradable. There's no supply demand characteristics. But the reality is that the market has said we're less and less nervous as time has passed, at least until now. We've had a series of when the VIX has spiked, as it is wont to do, we've had a series of lower highs with those spikes,
Mhm.
and the bottoms, have tended to be moving lower, right? We had just come out of that post-pandemic period where the VIX was stuck above 20 when you and I
Right.
last talked. And we've now settled firmly below 20 in terms of the bulk of the moves. We've had a few spikes above 20, but we seem to be settling down. Fear seems to be subsiding more broadly, even though, we've got the Delta variant, we've got Fed policy, inflation worries, and now we've got Afghanistan trying to pretend it's Saigon all over again. But generally things have just kind of settled down and gone sideways. I think did I switch slides on you?
Yes.
Excellent. Okay. So, looking back, similarly, obviously the S&P 500 has continued to notch new highs. And this is just another sort of peak using a 50-day moving average of the VIX index that shows that we've just kind of slowly receded. Fear has been ebbing out of the market. And as you guys were discussing, the $64,000 question is whether that subsiding of fear is appropriate given some of the potential headwinds we're facing. But,
Right.
it kind of is what it is. Looking back, when we were talking in April, looking at the SIBO volatility term structure ranging from 9 days to a year.
Yeah.
Since then, the short end, here's the beginning of the interesting stuff. The short end has clearly dropped, but you go out to 3, 6 months and a year, and we really haven't come in that much. So the front end, whether it's using the SIBO term structure, I'll show the VIX futures in a second, the front end has come down, but the back end has stayed high. We've really steepened the front end of the volatility term structure. And taking that SIBO term structure and looking at one of the relationships, this is the relationship between VIX 30 days and VIX 3 months, which stock charts still uses VXV, the old nomenclature. But, this shows how that relationship, the lower the chart on the bottom goes, the steeper that relationship between 30-day volatility and 3-month volatility is. And you can see that currently we're at very steep levels, very low levels for that ratio. And, I'm not going to say that indicates that the market's at a high and we're going to turn around, but it just tells you that conditions are stretched.
Yeah.
It's tough
That's
to
for
get,
sure.
it's tough to get that relationship to be steeper. And generally, when the term structure flattens, it's not a good thing for equities.
Okay.
And
So we
so-
go from steepening to flattening to backwardation would be the next step to where
Backwardation would be the next step. We haven't seen that in so long that it's hard
Yeah.
to remember what it looks like.
I mean, are they
Um,
going to ring a bell and give us backwardation on the first break from whenever a major high comes in, or does that happen after the first break? They start pricing that in, or the term structure shifts.
Yeah, in my experience, and everybody says, you never want to be naked short volatility because you could wake up the next day
Yeah,
and find out that you're
be
dead.
broke. Yeah,
And while that is theoretically true, my experience is that that's not usually what happens. And let's just take this chart and go back to the start of the pandemic, right?
yeah,
Let me see if I can. Yeah, here we go. So, you made these. The term structure was really steep back at the end of 2019, right? And
Yeah.
then what you saw was it started flattening. As this
Right.
line moves up, it means that the term structure is flattening.
Right.
And at the end of January, you had, that little pullback, which then everybody said, oh, never mind, everything's okay. And we marched back to new highs. And the term structure again began to steepen a little bit, but it never got back nearly as flat as it was before.
Yeah.
So, if you were short volatility going into the pandemic, really you weren't paying close attention. At a minimum, you had to be hedged. And, that's just one observation from this.
Okay. So you're getting the first signs that,
know,
at
so
least
we're-
now you wouldn't be short volatility now that we're compressed like we are right now.
Well, it's one of those conditions where you need to be thinking really hard about why you might be positioned. And again, as we talked about on the last show, there are 1,000 ways to be short volatility. There aren't that many ways realistically to be long volatility without bleeding to death.
Yeah.
But you do need to be
What's the
asking
best way
yourself,
where it's only a cut and not a hemorrhage?
well, there and I am not your options expert. I hang around with a lot of people who, are pretty sophisticated in how they can put themselves into a position where they've got some long volatility exposure while minimizing the bleed. It's not easy. And, it's one of those things where timing can be everything, because you don't want to spend your whole life being long volatility.
No.
It's just not going to pay off. And, so I think any way you look at it, I would argue that there's an element of timing that is useful. To be
Yes.
long vol all the time is not, to me, is not a smart way to play it.
Okay.
There've been a lot of studies done on hedging portfolios. AQR did one that's been widely read, looking at hedging portfolios with index puts, and how it really just is not very efficient. But it's one of the big product innovations of the last couple of years are exchange traded funds that offer downside protection. I mean, it's like hotcakes. They are selling fast and furious. And, I think every investor who's paying attention has concerns that some of these all-time highs can be taken out of their portfolios in relatively short order. So everybody's looking for the answer. And the truth is that, there's no free lunch trying to hedge a portfolio or go long volatility.
Yeah. In fact, what the sentiment and what I'm getting is that people are saying, why should I hedge? It's a waste of money. And they've been right since, the lows of the COVID crash and, but you don't buy fire insurance for your house hoping there's going to be a fire.
No, you
Right?
don't. And
Yeah.
I think one of the
So I think
challenges
most are
work,
unhedged and heavily margined. What do
I
you
work
think?
with a lot of, smart people who hire me as an advisor because this is not what they do. They're
Right.
really good at what they do and they need some help on the investing side. The biggest challenge I find is people sticking to a strategy when markets get a little wiggy. We can look back now and it's easy to look back and say, hey, that whole COVID thing was kind of a non-event at the end of the day. All you had to do was hunker down and stick to your program and it all worked out. But, the first week of, or the second week of March 2020, a lot of people were deeply concerned that, this was going to
Yeah.
be ugly on a sustained basis. And getting people comfortable that the strategy they have is going to accomplish their objectives, and is something that they can stick with through the easy times and the tough times is the big challenge. And that's why some people feel comfortable having a hedge in their portfolio, even if they know that it's not necessarily optimal from a return standpoint, it helps them sleep at night. It helps them stick with their strategy. And at the end of the day, that probably is the right decision to make.
Okay, I know you're a little hesitant, but let's just say for yourself then, you're not recommending it for anyone. What would be your way of hedging a market that has become parabolic and stretched like this?
So,
For you, Jim.
look, yeah, I am a volatility guy, and I use the exchange traded products that are out there. I'm working with some folks I know to try and introduce some new ones, and we've been hoping for a while. It's kind of roadblocked at the SEC, but I will from time to time take a position long volatility through the exchange traded products as a way to hedge a portfolio. That can be VXX, could be UVXY, used to be TVIX, rest in peace. On the short side, it used to be XIV, SVIXY, is available now. And those are tools that I will use, but systematically and again, with some element of timing, to give myself and some of my clients exposure either on the short side or the long side of volatility.
Okay. And when you are implementing this, we've been in an ongoing bull market, so there's not even any perception of anything but, like, you addressed COVID, which was, I don't know, what, 30-40% decline that happened in a few weeks and disappeared in a few months.
Right.
What's the average hold time for anyone that you would advise? And what if we end up having some type, instead of being a crash this time, we end up having, a garden variety bear market that, can last, 6 to 12 months and not just be kind of like a flash crash and it's over. Is there a way to, position yourself, or do you always have to be a trader when you're using these things?
To me, if you're using, and again, most of the people that I know who play in this space are traders. They don't view themselves as long-term investors, although there are some long volatility funds that tend to stay long volatility, and may, during a crash period, monetize some of their gains to reinvest. But most of the people I know who work this space are traders. They have some systematic approach, either in the options markets, the futures markets. Obviously being short equities is long volatility. And, I know people who use the inverse equity ETFs as a way to express a long volatility position, right? If the S&P is going down 10% in the next 3 weeks, you buy the triple inverse, and you can have fun. You can also get your face ripped off.
There's an interesting question. I don't know if he's a follower of yours, from Lincoln, Washington.
Right.
He was saying, Jim, be interesting to hear you talk about the more than normal spread between VIX and VX1, VX2 that's close to VIXpiration, how that normally runs, and how that compares to the last 2 days and tomorrow.
So let's do that.
See, when you need something to talk about, there's always someone with a good question.
So quickly, again, drawing the contrast between the last time we talked and today, it's interesting that the VIX futures term structure, is not dramatically different. And again, interestingly, you can see that the back end is anchored at a relatively high level, still right around 24. The front end has come down and it's relatively steep. I posted this to Twitter. This was a close on Friday. And the front month future, which expires Wednesday morning, was at 1670 against a 1545 VIX. Obviously, VIX has popped up today.
Yeah,
So it looks like the futures guys had it right. But that spread of 1.25 points with 3 days to expiration was, call it 3 times the normal spread with 3 days to expiration. So the spread between the second month and spot was, again, sort of 3x what you would expect with 3 days to expire for the front month. So the spreads, the front end has been very steep. The spreads have been very wide.
no one wants to give them away.
No one wants to give them away. And so the bet is on, right? Because if you think that VIX is going to stay in the 15s until expiration Wednesday morning, then you want to sell that front end future. And I think part of the reason that the term structure has been as steep as it is because there have been people selling that front end against a declining VIX because that looked like a, reasonable probability to make some money. Today has kind of shaken it up a little bit. We'll see what happens. I'm a little bit, you guys were talking about it a bit before, the situation in Afghanistan, to me, was pretty predictable the end of last week. I mean, it's not like Kabul
Yeah.
wasn't going to fall. So it always kind of amuses me to see the future selling off on this quote unquote news, which to me, I don't know how is
Yeah.
this news?
Well,
But
yeah, I mean, just, the process it's in. Charles Northermer is saying it was predictable a month ago,
right.
what was going to happen there. We don't have a lot of time left, but I'd like your opinion. If I could just share my screen, unless there was another
No, I'm
slide.
done.
Oh, really? Okay. I want to ask you this since you trade the VIX. Okay.
You need me to give you the screen back, or can
No,
you
I
take
got
it?
it. It's coming to me. So, here we go. So I want to ask you about this because it was something I was noticing for quite a while. It was back, maybe it was here. Okay, you see all the way to the left in here
Yes.
where I had my cursor? You
Yes.
see these wicks?
Yes.
And if I go to the left, there were more of them.
Yes.
Okay, where it would open down here. Did anything really ever trade when these prices were showing up? And to you who watches the VIX a lot more than I do, did this smack of accumulation that, they would try and take it down near the opening, but probably hardly even trade it down here before the candle closed? I know this is a 4-hour, but
Yeah.
we were even having these kind of wicks on a 15-minute TF.
Yeah. So again, everybody has to remember that you can't buy or sell the VIX index. So the VIX index is calculated from the values of S&P 500 index options. And you can go back and in, with an extended hours chart, see those wicks fairly regularly, typically at about 8:30 Eastern time, so pre the market opening. And I've quizzed any number of people, what the heck is going on? What is this? And the best answer I've gotten, and I don't know if it's the right answer, is that you've got market makers essentially resetting their bid ask in these S&P put structures. And so you sort of have a little flicker. I hit the reset button,
Right.
and for an instant, it pulled my bids and offers from the market, and so the market said, "Hey, wait a minute! Nobody wants these things. VIX has to go down." So, as best I can tell from people that I've talked to, it's one of these strange little anomalies. And again, VIX is not something that trades. It's quoted, but it doesn't trade.
Okay. So what's the best way for people to follow you and learn more about the VIX, Jim, on Twitter, or do you have a
Yes,
website?
Twitter's the best place.
At
at
Vixologist.
Vixologist.
Yes.
And I am, I do advise private clients from the Toroso platform, TOROSOINV.com. And
Okay.
happy to engage. DMs are open. Just don't
Okay.
hate me too much.
All right. Well, Jim, thanks so much.
You're welcome,
Again,
Dale.
Yeah,
Pleasure to be
really
here.
appreciate you being here because, it's a lot of this is foreign to me. And, if it is to me, I'm sure there are a lot of people that got some clarity today with some of the slides that you showed. I appreciate your giving nature to come in here and share your hard work with us.
Well, I'm happy to do it, Dale, anytime.
All right, everyone. So that's going to be a wrap. We'll see everyone for Turnaround Tuesday. Jim Carroll, thank you very much for being with us today. Follow Jim on Twitter at Vixologist. For anyone, I think people are going to start paying more attention to the VIX in the next 30 days. And Jim would be a great intelligence gathering source for you. And that's a wrap. Remember, don't just count your volatility, count your blessings. And we'll talk to everyone tomorrow. Adios, good hunting, and you could join the crew in 14 minutes on Morning Edge. And that's going to be a wrap. See everyone tomorrow. Thank you. See you, Jim.
Thanks, Dale.
Adios. So. There you go.